Call this meeting to order, 7:30 on July 19th, 2021. Roll call, please.
Supervisor Roush.
Here.
Clerk Matei here. Treasurer Hart.
Here.
Trustee Babel.
Here.
Trustee Blackstock.
Here.
Trustee Nuts.
Yeah.
Trustee Richley.
Here.
All right, join me for the Pledge of Allegiance. Pledge allegiance
to the flag of the United States of America, and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Thank you. Moving into the approval of the agenda. Is there any additions or deletions to the agenda as presented? Hearing none, a motion to approve the agenda would be in order.
So moved.
Support.
We have motion and support to approve the agenda as presented. Any further discussion? Hearing none, all in favor signify by saying aye.
Aye.
All opposed? Agenda carries. Approval of the minutes in your packets. If there's no discussion, a motion to approve the minutes would be in order.
I guess I'll do it now instead of at the end. In today's minutes, in the minutes, it says that, I can find it, members' comments. I thank the Dina for doing a good job on putting up, and I said that Elmwood Riverside vacant lot's got 3 feet of tall grass. Well, guess what? Elmwood has still got 3 feet of tall grass. Somebody went over there, and I don't know if it was our guy or not, but they just run around the border, reached in with a cutter probably about 6 feet. The lot's still a mess. And so I'll just bring it up now instead of later in minutes, but we need to, it's really getting bad now. They cut away from the street, but they didn't do the lot.
Yeah, I saw them out at the.
Other than that, I'll make a motion to approve the minutes as they're presented.
They were doing it all over the place.
Yeah, Not thought to blame about that.
Okay, Beth made a motion. I'll support.
Motion and support to approve the minutes. Any further discussion? Hearing none, all in favor signify by saying aye.
Aye.
Okay.
All opposed? Minutes carry. All right, presentations. We got 2 of you guys. We'll start with UHY because you're on the sheet first.
Hello, everyone. Good to see everybody again. We have completed our audit of the financial statements for the township this year. I want to go over the bound document that I've provided to the board. The first thing I'd like to bring to your attention is our independent auditor's report on pages 1 and 2 of this document. This is our report on your financial statements. And in the report, we give you a unmodified opinion at the top of page 2, which is the best report you can receive on a financial statement. Below the opinion paragraph, we indicate that we've adopted GASB Statement 84, and that's changed the presentation of the current tax fund. It now is required to have an operating statement, and we'll see that when we walk through the statements. I'll move to the basic financial statements, and I'm on page 8. So we have on here, this is the statement of net position. So this is your government-wide presentation. It includes all your assets, fixed assets, and all your long-term debt. So it includes the net pension liability, net OPEB obligation, and so it's on the full accrual basis. And you can look down and see the net position for the 3 areas. Your governmental activities, those would be all your governmental funds that are more or less consolidated, your general fund and special revenue funds and debt funds that you have. And then the business type activities, that would be your water and sewer operations. And then we have the component unit on the far right column, and that's the authority. So you can see that, you know, the big obligations, the OPEB and the net pension liabilities, those get spread, and you can see it's spread between the governmental and the business type activities and the component unit, the authority. So you can see between the primary government, it's $1,172,535, and a very substantial amount is allocated to the authority, which is $2,527,483. And that's due to the way the people work within the township. That's why there's such a substantial amount of portion to the authority. We'll get to the unrestricted deficit that's shown here. You can see in the middle column, the business type activities, there's a 609,448 unrestricted deficit, and that gets allocated between water and sewer, and I'll go through that in just a minute. So turning to the pages 9 and 10, you can see the operations for the governmental activities on page 10 toward the bottom of the page. You can see that the governmental activities actually show a reduction of $444,483 in your equity for the year. And the business type activities added $683,918 to their equity. And the component unit, the authority, basically all their expenses are allocated and paid by both the East China and China Townships, so that they all get spread. And then turning to page 11, you can see the balance sheet for your governmental funds. You have two major funds. Your general fund is always a major fund. And then the Township Capital Projects Fund this year is, because of its size, is a major fund. And looking down toward the bottom of the page, you can see fund balance again. And for the general fund, it's $1,486,450. And most of it is unassigned, which means it's available for your current operating budget in the current year. And then you can see the Township Capital Projects Fund, they ended up having a fund balance of $955,565. And your other governmental funds, those are all the other special revenue debt capital projects funds that are not major. All those funds get combined in one column, and then there's the detail by fund is in the back behind the notes. If you flip to page 13, you can see your statement of revenues, expenditures, and changes in fund balance, your operating statements for these major funds. And you can see in the first column, you actually reduced your fund balance by $73,408 in the general fund, and you added $203,253 to your capital projects fund. And then we turn to pages 15 and 16. This is the proprietary funds statement of net position. We have water, sewer, and then the DPW fund, internal service fund, is the far right column. And I wanted to, as I said before, point out the unrestricted deficits. If you look at, you have in the water fund a $51,767 deficit, and in the sewer fund a $557,681 deficit. And the DPW fund also shows a deficit of $146,524. So as I talked to the people that attended the closing meeting, there's some monitoring that should be done, especially with the sewer and the I think the DPW fund. You should look at the charges that you're currently using to make sure they're covering all the costs associated with the DPW activities. If you flip to page 17, we can kind of get a sense of what this entails. Your water fund seems to be doing fairly well. You can see the change in net position was $127,480 if you add it to your equity. And I always look at, the operating losses. The water fund had a $212,000 operating loss, but when you add back depreciation, you earn a positive with that. So I feel, that's, you're not actually charging for that replacement of those assets currently. Eventually those assets will probably go out and you'll bond for the project or get some kind of a grant, that type of thing, or you'll fund it in another fund to transfer over to meet that obligation. Your sewer fund, on the other hand, is, you can see that you have an operating loss of $464,050, but currently the depreciation is $290,000, almost $300,000, so you're not covering that deficit.
Doesn't that, it's a series of false position, because they check, you chop in there a whole bunch of depreciation, which, as if we were going to fund it,
No.
and we aren't.
Right, and that's why I'm adding it back, to just
Okay.
demonstrate that there's that cost. You're currently in a project now, it's ongoing in the sewer fund. You moved a lot of, basically you moved money out of debt funds that have over accumulated into this fund to pay for the current costs, and I think you have some grant funding that you're going to utilize in the future to. So, this one's kind of in flux right now, and I know you've been very diligent in, maintaining, monitoring those rates and increasing them as needed, I guess, to, cover for inflation and things like that. So I'm just bringing it to your attention, just to kind of keep track and monitor that. I did indicate at the meeting, kind of looking at the cash position and making sure that that cash is staying in the positive. If you see throughout the year that you're not meeting your cash obligations, you probably need to look at the rates and take a look and see if you need to increase that. And as I said, the internal service fund, that is subsidized with, money transfers in. You might want to look at that if you feel the rates, you're comfortable with the rates, but you're obviously going to have to pump some money in there if you want to keep the equity in the positive for that fund.
I'm looking at that now.
And on 19, this is what I was talking about. They're now custodial funds. They used to be, it was an agency fund, your current tax fund, and agency funds, you just showed basically the additions and deductions on a balance sheet. That's all you presented. Now the requirements under the new standard 84 requires an operating statement. And only in this case, your current tax fund, only the collections relative to parties outside of East China itself are reflected here. So you had, for the year, almost $16 million in tax collections that you basically allocated out to the schools and other, governmental units. So that's what's reflected there in the first column. And then your other post-employment trust fund, that's the monies that you have put into a trust to fund, I guess, that OPEB obligation that you have. And you can see for the current year, you added $50,000 contribution. You had some earnings that net of the fees was $71,065. So you did actually add $121,000 to that trust for the current year. And then after page 19, we get started with the notes on page 20, and they go for quite a long period of time. The first part of the notes is basically the description of your entity, the township, and the components that are included within the entity. And the authority, that joint venture you have with China, is reported as a discretely presented component unit because it is legally separate. But townships are still financially accountable for it, so that's why it gets incorporated into your entity. You also basically provide all the administration, bookkeeping and that nature. You also staff the authorities, sewer and water plants with your personnel. So those are all reasons that the authority ends up in your financial statement. And then I'll just flip through this and go through just what I think is significant. There is a new standard on page 27 that will be required to be implemented for the year ended December 31, 2022. It's on leases. Let's see what else. As I said at the meeting, I believe your budgetary, you didn't have any budget overages within your general fund or special revenue funds this year, so nothing to report there. We did report in that paragraph, I'm on page 28, other, that you do have those unrestricted net positions in the water and the sewer fund and the internal service fund, the DPW fund. So that's indicated there. Now, you don't have to file with a budget reduction plan with the state of Michigan because in all three of those cases, you had current assets in excess of current liabilities. So that negates having to submit a budget reduction plan with them. And let's see, I go through, on page 33, you can see a table on your capital for the year. Looking at the business type activities, most of this is related to the water fund, but you can see you got $926,000 in construction in progress. That's in the additions column. And you actually added another $418,000 to utility systems and some equipment. I think that, again, is primarily associated with the sewer fund. And let's talk about the pension, net pension liability. Looking at that, I'm on page 39. There's another table in there. You can see that we break out in the first column the total pension liability of $9,000,005, and then the pension plan's net position at December 31, 2020. That's the assets that are held in MERS on your behalf. You can see it's about $5.8 million. So the net pension liability to allocate to the funds within the township is about $3.7 million. And you can see you're at a funding level of 61% currently. And then the other post-employment benefit, your retiree health care plan, shown on page 44, the similar table. You show a total OPEB liability of $832,814 and assets in that trust of $744,513. So you have a net OPEB liability to spread of $88,301, and you can see the funding level of that is at 89%. So you're in much better condition there. And as I said, we did have that change in accounting principle. I'm on page 48. That's just disclosed and adopted that standard on fiduciary activities. Another thing maybe to look at is the principal taxpayer and utility customer. That's a DTE. And you can just see what percentage they represent of property taxes, wastewater treatment services, and water purchases. It's quite substantial. And then following the notes, on page 50, we show a budgetary comparison statement.
Could I ask you a question?
Sure.
Later on this meeting, we're going to be looking at a MERS report, which has to do with our funding of retirement funding.
Okay.
It has a percentage also of being how much of it is funded. Does that have any relationship with what the one you just explained on page 44?
Yes. I mean, we basically disclose, from the actuarial reports from MERS, their actuary, and that ends up going through a template to basically come up with the tables and
All right,
things.
then I guess one other question.
Yeah.
The thing that we're going to be looking at later on shows that we're 57% funded. It shows right here in your
All right.
page 44, 89%, which is a whole lot better. And I'm just
Well, that
wondering
was the OPEB
what's
liability. The MERS we show a 61% funding level for the MERS, the pension plan.
okay, where's the 89 come from?
That's the OPEB plan. That's your retiree health care plan. So you have a trust that you've set up.
Yeah,
and
that's different than the MERS then. That's what I was trying to get
That's for retiree
to.
health care, not the pension.
Okay, thank you.
So back to the page 50 in this statement here. As I said, you didn't have any variances that had to be reported here, but it shows the original, your amended budget, and then actual, and then the final column shows the variance between, your budget and the final amended budget and the actual results of your year. This next pages, 51 and 52, is a shows a schedule of changes in net position, or net pension liability. And this is going to show trend information for 10 years eventually. I think we've got 6 years presented now. And you can see just looking at the funding percentages, they're staying pretty consistent. You were at 60% last year. It's up just a percentage for 2020. You can see that another ratio to look at is your net pension liability is a percentage of covered payroll, and it's staying right at about 400,000 or 400%. And then page 53, we present the comparison of the actuarially determined contribution and the actual contributions that were made. You can see you're making the actuarially determined contribution, and the percentage of that contribution to covered payroll, it's now at approximately 47%. So it's quite a significant amount of your payroll. And OPEB is presented on pages 55 and 56, the same type of information. As I said, your OPEB liability is funded at a much higher rate. It would actually jump from 74% up to 89% between 2019 and 2020. And your contributions, you can see that we determined a contribution of about $40,000 is required for your OPEB, and you made a contribution of $87,000 for the year, so you actually provided excess over the actual annual determined contribution of $47,000. And that percentage of payroll is much less. You can see it's only about 9.52%. So, and then the final pages just are the non-major governmental funds that you have. And you can see on page 57, 58, you have 2 special revenue funds, the Parks and Building Inspections Fund, 2 capital projects fund, the Township Improvement and the 2013 Capital Improvement B, and debt funds 2013A and 2013B, and then the final permanent fund is a Cemetery Perpetual Care Fund. So these are the balance sheets for those funds, and then flipping to 59 and 60, you can see the operating statements for those funds. And the final page in your report is the budgets for the special revenue funds. So you have 2, the Building Inspection Fund and the Parks Fund, and those budgetary comparison schedules are presented on page 61. Are there any comments or questions?
I think we're good.
I know a little. Enough to have too many.
Yeah.
Enough to ask.
Thanks, Scott.
Too many
Have a good
stupid
night.
questions.
Thank you for being patient.
Does everybody have a copy? I brought copies with me of the report. Should I?
No, we didn't.
No, I only have a abridged version.
Thank you, sir.
What are you up to? Oh, you're the guy I was talking about.
Oh, boy.
Thank you.
This is the whole thing. What we got in the packet is just an excerpt. All right, got it. Don't need any more of that anyway. Who needs that page there? This is great murders. People are working the fund.
So thank you for having me tonight. This is my first council meeting back from all this craziness, so it's nice to be in person again. My name is Matt Kaler, and I'm the regional manager for MERS. I cover most of the Thumb region of the state of Michigan and surrounding counties, so I'm working with employers like yourselves every day on their pension plans, their defined contribution plans, 457 supplemental savings plan, healthcare savings plan. So I work with all of those plans tonight. We'll probably focus more in on the defined benefit piece or the pension piece. Okay. Sorry about that. So we're going to focus on the defined benefit piece, but before I get started, are there any comments, questions, concerns, anything you'd like to share, feedback in terms of MERS, how we've provided service? It's been good, bad, otherwise experience? Or any questions you know that you would like to have answered?
Yeah, I just have a general comment. There's a table 7 in your thing of it, and it shows a percent funded since 2006. Having been on this board way back in 2006, we thought we were doing really well. We didn't change anything, but the percentage went to hell. What happened?
Yeah, well, it's a good question, and why an employer's percent funded would change is probably a little bit different for every municipality. It could be a number of things. Assumption changes, what the market does, the demographic itself, so the participants within the plan, all of those sorts of things make a difference. I would say most recently, most of our employers have seen a bit of a dip in their funded percentage because of the assumption changes that we've made as a result of the experience study in 2018. Those were put into place in early 2019, and they were in two pieces. One was the economic piece, so we lowered the rate of return. And then in 2020, in this report, you would have seen the changes in the demographics. So we used our third-party actuarial group, GRS, used a different mortality table. So we went from a static table to a generational table. So a lot of our groups did see a dip in funded level.
Okay. Well, I just wonder if there were some other things besides the fact that perhaps your investors weren't doing really well.
Yeah, well, it does, pension plans are impacted by by the rate of return or how much money we put into the plan. If you have a 2008, certainly you're going to have repercussions there, and all of our employers did. But when you look at the long haul, the last 35 years, we've returned 8.69%, I believe it is, and that's in the other booklet that I
We didn't change anything as far as what we were contributing to
No,
MERS,
no,
and
the
the
township-
percentage just went to the devil.
Yeah, the township has made their minimum required contribution all along. So there haven't been any changes there, but even when an employer makes that payment, it doesn't guarantee that, that you could lose a funded position depending on what happens again in the market, in the demographic.
Just sort of irritates me. We didn't do anything wrong, but now we're getting pinged because our percentage is too low, and we're working on changing that, but.
Yeah.
Right.
Well, it's a fair statement, but it's not intentional. We are making changes to the plan, changes to the assumptions that we believe as the fiduciary of the plan, that we're making the changes that will allow for all of our employers, including the township, to get the right amount of money into the plan to make sure that future promise, that promise to the pensioners in the plan are paid, what has been agreed upon. So I
Those
certainly.
large amounts then in, starting almost 214, 213, where the liabilities numbers increased substantially, or almost doubled from between 206 and 210, 220. We didn't add any new employees, but you doubled the cost of the liability.
And again, those assumption changes did have an impact, so there's more liability. So when you think of a pension plan on a scale, you have the assets on one side and the liability on the other. As you increase that liability, that scale is going to get offset. For instance, as I mentioned, when we change the demographic assumptions and mortality table, people are living longer. So if people are living longer, that amount, that liability is going to increase, and the amount that the employer has to pay is going to increase.
Okay, thank you.
You're welcome. Any other questions? Okay, I'm gonna flip through here. I'm gonna start on, since we've already kind of talked about it, I'm gonna start on page 6, where we see the funded position, funded level has increased a percentage point in 2020. As I mentioned earlier, most of our employers saw a bit of a dip in 2020 because of the assumption changes. Not the case for the township, and I would attribute that to some of the changes that you've made with the provisions of the plan, so lowering the provisions of the plan, and then also additional contributions that you've put into the plan. So that's had a positive impact, and you did see an increase of 1 percentage point. Now, I know it doesn't seem like, something to celebrate, but when you consider most of our employers, a lot of our employers, I've seen 5, 6, 7% drop in funded positions. So again, I understand that, in your shoes, you may not see that as a big win, but I would say collectively or in context to most of the other groups, I would say it's positive. You increase your employee contribution to 6% in both divisions. You're going to see your contribution rates on page 7. And that annual contribution has actually went down a little bit from 2019 to 2020. And again, this is a reflection of the year 2020 and costs for year 2022. So I'm going to move to page 10. So the next 3 pages all kind of show the same thing in a different way. So I'm going to kind of touch on each of them, but on page 10, we provide a couple of different scenarios. So for the employers who feel like maybe our 735 rate of return is high, we do provide a 5.35%. So I'm looking at the top left chart on page 10, and then moving from left to right, we provide a 6.35% rate of return, and then what it currently is at 7.35%. So these costs and funded level projections are all shared here. So if we were to return 5.35%, the plan itself would look more like a 46% funded level, and then the amount paid in would be $48,346. Again, moving down the chart.
What is your current rate?
Our current rate is 735.
735. Your funds are returning 7.35.
That is the target, and over the long haul, yes, we've returned. I believe it's 8.669 going from memory.
Okay.
So there's a couple different projection scenarios here. The same is shared on page 11, but if you flip to page 12, I really like the graphs here. And I did want to touch on a couple of different things here. So when we look at the top graph, funded percentage, each municipality in MERS or each MERS member is on a schedule to be fully funded in what started as 23 years. We are now in year 18 of a fixed amortization. So it's not the exact same thing, but it's similar to a home mortgage. So over time, we pay off that UAL, unfunded accrued liability, and this chart shows that how that will happen. Now, it's a projection, one point in time here. The graph at the end will not look like it does here because things will change. We'll have good, bad market returns, and it will fluctuate. But again, the idea is to become fully funded out there in the future in 2040. So we're chipping away at that unfunded accrued liability or legacy debt while we're also making contributions for current employees who currently are active.
Detroit.
So the different scenarios are shared here. So the scenarios that I just mentioned are shared here in both graphs. And I'd like to point to the 735 with surplus. That's on the top of page 12. What that means is that the township has opened what we refer to as a surplus division. And what that's designed to do is receive additional contributions. So you're making that minimum required payment, but you're also paying in over that amount. And the idea is to catch up or to get that unfunded accrued liability paid. Last year, the township made an additional contribution of $172,139. So that's a good thing. That's something that we do recommend that our employers do, is to make additional contributions, and that surplus division is designed to stash those assets away in the plan. To give you another analogy, the way that pension plans work are similar to a credit card. If you make a big additional payment on a credit card, the next payment that you get it would be lower. And that's how it works in the pension world as well. So what we've designed the surplus division to do is to set those assets aside, but continue to pay at the same rate, or to continue to more aggressively address the unfunded liability in the plan. That's what's really, the unfunded accrued liability is really the challenge that most of our employers meet, that legacy debt.
Are those all employer funds, the surplus, or is there any employee?
No, they're all employer funds. And on the bottom of that same page, 12, you'll see the employer contributions out over time. That blue solid line is where we are currently at. And so the costs are going to continue to go up. It's not at a real sharp pace, or, it's not going to go up exponentially as it's projected here, but out over time, out to that 2040, you are going to see costs eke up over time.
No, make any sense. Why does it go to zero? We aren't planning on going away anytime soon.
Yeah, you don't. It won't go to zero, because as long as we have actives in the plan, the township will be required to make those make those contributions for the actives in the plan.
What is this graph telling me then, when it drops off like that?
What that drop off you see right there is where the unfunded accrued liability comes out of the plan, because if you see in the top chart, you see that the funded percentage has become 100%. So that means that you paid off all that this is the wrong way to put it, but bad debt, if you will. And now we're just paying for the contributions are going toward one more year of each individual accruing another year of benefit. So they happen at the same time. We hit 100%, that unfunded accrued liability is out of the plan, and now we're just paying for that, the employees. I'm going to flip to page 14. And as I mentioned, in 2017, the township, and 2018, bridged the defined benefit plans, or both divisions. If you're not familiar with that term, when we look at a individual participant's retirement, we use a calculation of their final average compensation, their service credit, and then a multiplier of some sort. And usually that's between 1% and 3%. So we multiply those three factors together. That gives us the participant's annual benefit in retirement. So the higher the multiplier, the richer the benefit. So what the township did in 17 and 18 was reduce those benefits for both divisions. So you went from a 2.5%, which is a higher or richer benefit, to a 2.25% multiplier, which is, I would say, is more moderate, if you will. So that, again, on the scale, assets, liability on the other side, what the township did was lower that liability going forward. So you're paying less of a benefit after those dates. So May of 17 for Division 1, and looks like February of 18 for Division 10. So I'm an employee too. No employee wants to see that, but from an employer standpoint, that's what we saw and have seen, continue to see. A lot of employers move in that direction. We're gonna make that plan a little bit less, not as rich of a plan. Any questions there? So Table 3, this is your demographic in each division. So you have your active employees, obviously those are the folks that are working right now every day. Then you have your vested former employees. So that's someone who's worked for the township, they achieved that vesting, they were here long enough to vest, so they are eligible, or when they become eligible for a benefit, they will draw, and that money is kept in the plan for them for that future date when they are eligible. You have the retirees and beneficiaries. Obviously, those are the folks that worked here, retired, and now are receiving a benefit every month. And then the pending refunds, and this is kind of a tricky way to say it, but we're tracking the folks that were here at the township, they didn't meet the vesting requirement, and they now say they've since moved on. Well, if they move to a different MERS employer, they can continue to work towards that vesting period. So we are tracking them, and we know they're out there, if you will. And until they take out their money, the employee dollars of the plan, they're still eligible. So if they can achieve that, maybe they come back to work in 5-6 years, they can still achieve that eligibility in the future. So we do want to make sure that we're noting them as well. I'm going to skip to page 17. And this is more like your home budget, if you will, and looking at the road 2020 at the bottom. On page 17, moving left to right, you see the contributions that the employer made into the plan last year. The additional contributions, as I mentioned, $172,139. You have employee contributions of $53,162. The investment income is what MERS has invested and put back into the plan. Outgoing payments of over $668,000. And then you have an asset balance of $5.6 million.
We're doing really good. You guys don't keep changing the rules.
I've heard that bit of feedback a couple
But you
times.
have.
Table 6, again, this is, left to right for both divisions, also includes the surplus division. You have your liabilities and your assets in the plan. I know that the gentleman that was here earlier talked a little bit about that, but that's where we get our funded position, your funded level of 57%. So as I mentioned, you have a total liability of over 9.8. The assets that have been put away in the plan are at 5.6 and are 57% funded as of 2020. We talked a little bit about Table 7 already.
Increase the assets.
We have seen a decline in the funded level, but I would say that on the whole, there's really two ways to improve the sustainability of a pension plan. One is to put in additional dollars, and the other is to change the plan itself. So make it, bring those provisions down and put more money in. And the township's doing both of those. And again, going back to what I said earlier, I know that's not something, it doesn't sound real good, but you are making the decisions and the choices to improve the benefit, and it is heading in that direction. I'm not going to go into the GASB portion.
I'm sorry, I just noticed something here. It said, there's a note in here about the previous, before 18, directly received from prior actuary. We've been dealing with MERS for a whole lot of time, so are you from MERS, or are you from whichever actuary MERS is employing?
No, good question. We do have a third-party manager, third-party actuarial. That's by design. That's Gabriel Roeder-Smith. They put this valuation together on behalf of MERS. I am a MERS employee.
And that actuary changed in 2018, therefore the reason for the note.
Well, I'm not sure that, where are you referring to? I'm sorry, maybe I didn't.
Page 19,
Yes,
note on the bottom.
Oh, yes, I'm sorry. Yes, we had an RFP at the end of 17. CBIZ was our actuary at the time, and we are now with Gabriel Roeder-Smith.
Okay, thank you.
You're welcome.
Wonder how accurate those are.
I don't know that anybody, I'm not sure, but I don't know who for the township fills out the 5572 form, but just a note that's the note that goes, this is Public Act 202. Each year, each municipality fills out Form 5572, sends it into Treasury. Just to note here, all of the information that's required on that form is on the very back page of the valuation, and it makes life a lot easier as I understand it.
What is the form? Is it on?
5572,
Oh, yeah, right here.
yeah, the Public Act 202 was a transparency law that requires all municipalities in the state of Michigan to report on the status of their pension plan. All of those figures in detail are presented here, and they're all in the valuation, but it's just a cheat sheet, if you will. I don't have any further prepared remarks. I do have just a couple quick notes, but are there any questions about the plan or anything that I didn't cover or you were looking to?
When we made that, I think 172,000 additional deposit, was that a lump sum or over the year?
That's a good question. I can't tell from the valuation, but I could find out for you. Municipalities do it all different. Sometimes it's just additional a month. I don't see that detail, but I can find out for you. Just a couple housekeeping notes, if there's not anything further. MERS is holding our annual conference in Grand Rapids at the Amway this year. That will be in person in October, 7th and 8th, going from memory. And then I also wanted to mention that I work on a team that covers what we refer to as Region 2. We do have an education specialist. His name is Andrew Smith. So, where I'm talking more with folks like yourself, Andrew Smith would be working on the education piece with your individual participants in the plan. So what the plan does, what it does for you, the value of the plans itself. So I'm happy to help schedule that if at some point you'd like to have Andrew come in. If there isn't anything further, thank you again. I appreciate it. Good to
I
meet
do
you.
have one question.
Yep.
So the plan for tonight,
Learned all I can handle for this time.
we have to adopt the required employee contribution. So is that basically saying that we want to stay in the 7.35 and we would like to look at whatever extra we would, I guess, is that what we're looking for tonight out of this?
I missed the very first part of what you said. You said,
Oh, I'm just kind of looking to see what we're trying to adopt here. So it's written as adopt the 2022 MERS required employer contribution. So is that basically saying that we're going to stay with status quo, how we're doing?
The rate,
yeah,
the rate normally changes every year.
it does. That is true. So, yeah, yes is the short answer. What the contributions that are listed in here are contributions for 2022. So it wouldn't begin until fiscal year 2022. So if you're adopting that tonight, that rate wouldn't start to 2022. But yes, they do fluctuate, and that's part of a pension plan that the employer's rates are continually move up and down, whereas the employee rate is fixed. In most cases, there are exceptions to that, but in most cases.
So we'd be I'm looking at page 7 then. That would be the employer rates would be the, well, right now it looks like they're at, I'm not sure if we're at the phase-in rate or the no phase-in rate, the 38.87 or the 41.63.
So I would look at it on page 13.
13 or 7.
And
Talks about the rates by month.
Your annual contribution will be $399,000, so it's $33,250 a month.
Oh, it's not a rate?
And where do you see that?
Yeah, because
Page 13.
these are closed divisions, so we flat bill rate, so we don't use the percentage, so it's like the total liability divided by 12 months.
Okay.
But that's, at the end of the day, those will be your contributions are listed here.
Okay, just flat amounts.
Now, what is the difference between no phase-in or phase-in?
Great question. So it used to be that we used the phase-in rate, and what that is at the end of an experience study, like the one that we went through, there's additional liability. So we allow for, or that liability can be paid off in a 5-year period. So what we call phase-in is where we're paying a little bit of that off each year. And the no phase-in is you're tackling it head-on. And what we found is our employers, that's what they wanted to do, so that's the default right now. So you're paying for that, that's additional liability
Is a no
head-on.
phase-in?
Yes.
That's the default right now?
Yes.
As I read this thing, it says that this estimated annual contribution gives you 3 different levels, and that's what they were talking about. But note 1 right underneath, it says the above employee contribution requirements are in addition to, I got it, never mind. So that includes both what would have been our normal contribution plus the makeup amount that we're trying to, so we can catch up?
You got it.
That's all figured in there?
Yep.
Okay,
got it.
thank you.
So basically, we need to decide if we want to do no phase-in or phase-in, correct?
You
Or no, actually,
you don't have to
that's
make
default.
the decision, but you
Yeah,
can
that's
choose,
default.
yep, you can choose to do phase-in if you'd like. I can't advise, but if you feel comfortable with the default, that's probably the more,
Safer
yeah.
approach, right?
I guess I'm going to have to ask you to do that again. What is the difference between computed employer number phase-in, computed employer contribution with, it says the same thing twice, and it's got 2 different numbers.
Yep.
No, the one says
One's
no
no
phase-in.
phase-in.
Oh, that's
Phase-in.
computed with no phase-in, and the other one's with the
With.
phase-in.
Phase-in, no phase-in is $33,250.
You just pay it off quicker with the no phase-in, right?
Yes.
And that's the default. Excuse me.
Would we meet our legal requirements by
In both.
continuing with the phase-in number?
Yes.
Thank you.
All right. So the recommendation by you guys is the $399 this year. That's what the default is. And so unless we were to change something,
Yeah,
that's the default.
again, I can't recommend or say, that's the required. So that's what has to be paid. But as we discussed, making additional contributions, and is listed in here, making additional contributions is a good idea. You've done that in the past. I think it's benefited, the plan. But in terms of what's required to be paid into MERS is stated here, and yes, that.
I don't think I have any questions. Any further questions?
Thank you all.
All right, thank you.
Thank you.
Auditor and MERS right back to back. That's
Ooh, yeah.
that's
I
quite
know.
a Monday.
Yeah. Thank you for sitting through.
Yeah.
Good night. Safe travels.
Take care. Thank you.
All right, so that's it for presentations. We have no public comment. So moving into approval of the consent agenda.
The only thing on the consent agenda is the financial reports, right?
Yeah.
I only have one comment on financial reports. I was going through them. My favorite one, the R&E report. They're all nice pages. Page 21 is missing. I hope it wasn't anything important.
Uh-oh. 21, huh?
It skips from page 20 to 22. Other than I don't have any useful comments tonight. We seldom have any useful
Sounded
comments
good.
anyway.
All right, if there's no discussion, motion to approve the consent agenda would be in order.
I'll make a motion to accept the consent agenda as presented.
We have a motion with support to approve the consent agenda. Any further discussion? Hearing none, signify by saying aye.
Aye.
All opposed. Motion carries. All right, we have disbursements. We have payroll, in the amount of $33,713.50. AP, $152,541.92. EFTs, $16.86. e-checks, $302.30, for a total of $186,574.58. Invoices, $84,964.91, for a grand total of $271,539.49.
I'll make a motion to pay the bills in a total of $271,539.49.
Support.
All right, we have a motion, we have support to pay the bills. Any further discussion?
Yeah, are we saving money on commas? That's hard to read.
I know, I was like, what? I was wondering that myself.
I'll tell them to put the commas back in. That's the first time I've ever seen them do this.
Hearing no further discussion, roll call, please.
Trustee Babel? Yes. Trustee Blackstock?
Yes.
Trustee Natz?
Yes.
Trustee Richley?
Yes.
Treasurer Hart?
Yes.
Clerk Matei, yes. Supervisor Roush?
Yes. All right, pay the bills. All right, no old business tonight, so moving right into new business. New business one is authorize UHY to submit the required audited financial statements that we just heard.
So moved.
Support.
So we have a motion, we have a support to authorize UHY to submit the reports as required. Any further discussion? Hearing none. All in favor signify by saying aye.
Aye.
All opposed? Motion carries. All right, new business two, adopt the 2022 MERS required employer contribution that we also just heard about.
Which one do we want to adopt there? Financial folks.
Well, that extra 30,000 would probably bring us up closer to where we need to be going.
Yeah, and we don't want to
Yeah.
fall below that certain percentage. 'cause
Well, we
we're
only have
right
two choices, right?
Right.
With phase in or no phase in.
Correct.
Well, we have the option to also add
Add
more,
extra.
Add extra too.
True.
Did- And I think didn't we arbitrarily add on our own additional amounts in the last couple of years?
Yeah, last year was an extra additional $172,000.
Yeah, so I don't know whether we don't have to say anything about that now, do we? You're just talking about paying this piece.
Right.
True, yeah. In 18, we put an extra 51,000, 19 an extra close to 60, in 2020 an additional 172. So I wasn't around for those years, so I don't know where that money came from.
Yeah, I don't know, was that
Right.
like a review of the MERS and then,
It was a
voted on, or-
recommendation, working with MERS, but I don't know what funds, I don't know if we have that money this year.
right?
Right,
Yes.
in the budget. Well, I would like to see us go with the default. No phase
Same
in,
here.
33,250 a month.
I would agree with that. And then we can always look at, towards the end of the year, what money we have left that we could
Put
fund.
extra in. Yep, I'll make that a motion.
All right, so we have a motion and a support to elect to go with the default, which is the no phase-in for $33,250 a month, with the option later in the year to look at additional funding. Any further discussion?
Okay, so you go with that when we're already doing an extra $37,000 or $38,000
30.
over and above what the minimum would be. Is that
Correct.
right?
Yep.
And if you want to do more than that, we can do it.
Yes.
But we do want to do at least that much.
Yes.
Okay. Just want to sure I got that straight.
Any further discussion? Hearing none, roll call, please.
Trustee Babel?
Yes.
Trustee Blackstock?
Yes.
Trustee Knott?
Yes.
Trustee Richley?
Yes.
Treasurer Hart?
Yes.
Clerk Matei, yes. Supervisor Roush?
Yes. All right, motion carries. All right, new business 3, the lot split combination application and fees. Threw an extra word in there. Yeah,
So I'm a little confused. We pulled up the old minutes from lot split board, and it says it was $85. For some reason, in my mind, it was $75 all this time. But this also says costs incurred by the process are not fully covered by this fee. The only fees that are that would be an expense to this, to a lot split, are basically, the assessor that's part of their contract that they're including, so there's no cost on the assessor end. There would be if they were to pay the two other members to attend the meeting. However, if we're here on normal business hours in the past, we wouldn't necessarily take the fee for it. So there could actually be no fee involved, or expense, I should say, against that. There is an expense that the assessor explained as far as resulting parcels in assigning addresses. He needs to contact additional municipality, DTE, Consumers Power, Semco, that kind of thing. So that's kind of the only expense that I'm aware of, would be like a mailing, postage kind of a expense.
Frankly, I don't understand this at all, because the thing you just handed us as a resolution
Right.
Yeah,
exactly what he put it. It says what the current ones are.
I know, that's why I was confused,
It's exactly what the current ones are.
especially when it said $85 on the
So I
front.
don't understand what we're trying to do.
Well, there was no additional $50 for the second through the fifth parcel. There was never a schedule like this.
Right. So the one on the back,
Before.
the one on the back is the proposed. So this is what the assessor gave us as a.
This is what it looks like when you put it legalese. Okay,
Correct,
got it.
yes. So yeah, basically, it's giving us the option to charge for the split properties as second, thirds, and fourths for the additional paperwork.
So it was just a flat $85. I could come in and split it into 10 lots.
Right.
Does anybody really understand this? Is this a good idea? 'Cause maybe I don't.
Yes,
Yeah, I don't think it's a bad idea.
it is. We've been
It's not a
reviewing.
bad
It is a good idea to do this. Okay.
Yeah.
That's what I wanted.
It'll bring us up to date.
Yeah.
It can be hard.
And it's still cheaper than other municipalities.
And does this meet the requirement that the assessor was getting at?
Yes, he's recommending these.
Yeah, and this is based off all the townships and municipalities that he works with.
Right.
So it's kind of a common schedule.
Just really quick, excuse my ignorance, I'm not used to seeing stuff like this, but like, what is it that are the things that are listed here, the things that are being additions to what?
It's the same, it's,
These are being adapted.
this is what they're,
Oh, what they currently are?
that's the resolution.
That's
that we're
okay.
gonna make
Right.
that implements that request.
Right, so basically it was $85 before.
That's just what I
for-
was trying to figure out.
For just the lot split, so if you come in, you have one lot and you want to split it into 10, it was $85. This gives us the option now for $75 for the first parcel, and then $50 for each additional, for the paperwork
Okay.
that goes along with each additional.
Gotcha, okay.
Right. I will move for the adoption of Resolution 11, 2021.
Was it?
Want me to read it? I can. Yep. Whereas the Township Board has the authority to establish fees for application of land division combination uses as ordained in the Code of Ordinances, Chapter 400-19, in the State Land Division Act. Now therefore be it resolved that the Charter Township of East China Board does hereby approve the application for land division combination and the split and combination fee schedule by the Township Board of Trustees effective July 19, 2021. Parent parcels, first parent is $75, second through fifth is $50, sixth plus is $25. Child parcels, first through fifth would be $50, sixth plus would be $25. Address assignment, 1 through 3 parcels would be $15, 4 through 10 parcels, $10, 11 plus is $10. I move for the adoption.
We have a motion, we have support to adopt Resolution 11, 2021. Any further discussion? Hearing none, roll call, please.
Trustee Babel?
Yes.
Trustee Blackstock?
Yes.
Trustee Natz?
Yes.
Trustee Richley?
Yes.
Treasurer Hart?
Yes.
Clerk Matei, yes. Supervisor Roush?
Yes. All right, motion carries. Last but not least, new business 4. So the civil infraction, basically looking at increasing the civil infraction fines to something that would be a little bit more, putting our foot down. So I don't know where these, I honestly don't know where these came from. Or Ralph, did you have part of this?
Yeah, that,
They're in the
I just
ordinance.
found, we were talking about it one day about why we don't get the building inspector or the code enforcer out there and hand out tickets, and then she found out, well, this guy hadn't been getting any tickets, and if he did get a ticket, it'd be $25. That is 2 burgers and a Coke.
Right.
Yeah, and so it occurred to me that the object of the fines was to discourage people from violating the ordinance, and so I thought maybe some more discouragement was in order. And I don't have anything except a wild stab as to what it might be. I would think that a first violation alone ought to be $100. I mean, if you're
Well-
going to try to discourage somebody from doing something.
There is one thing about this. This is every day in sequence. If every day they're in violation, the next day, they go to the second violation amount. The third day, so every day they're in violation, once they're cited, it can add up and accumulate.
You're talking about 50 the first day, 175 the second day, 200,
125.
375 the fourth day, or is that all the same violation?
I think he's just adding them together. So
Oh.
50,
Yeah, the first
I didn't think it
violation
worked
for
that
day
way.
1 is 50, the second day could be 125, the third day is 250, and the fourth is, add them all up.
I don't know if any time, I can't remember a single time they've given one, let alone given one every day to get somebody to do anything in this township.
We have, believe it or not, in the past,
Okay,
comes to mind.
I just wanted to bring it up. If everybody thinks it's
It doesn't
good
happen
as
very
is, I'm not
often,
gonna-
but it gets their attention when you start talking money.
when they get cited, I mean, they have more than 24 hours to fix the problem.
Well, typically, first, we send a letter, then, from the office, then they have 10 days to change or fix the situation. Then after that, it depends on how the letter is written, but this was in the past, that's what we did. And then at that point, the code enforcer goes out and checks on day 10. If they didn't correct the violation, then he can issue a ticket.
And then he
Just
goes
like
out the
the tall
next day and
grass
issues
thing.
another one? Is that what you're telling me?
Yep, until it's
If he'll do that, I'll
So
handled.
where does the money
I
come
won't
in
complain
each
if he'll do
day?
that. 'cause
After that 10 days, then these fees start accruing?
If he issues the tickets. Now, I don't recall how we ended up with this, but there was a shift at some point. At one point, the sheriff deputies were issuing the tickets, and then it went through the court system. And then, but once we first started the Civil Infraction Bureau, we had tickets in the office for the code enforcer. So I'm not sure where we're at with that, if we're doing it internally still, or if the sheriff is actually issuing the tickets at this point.
Well, one of the things to keep in mind, I have my favorite junkyard dealer down there on Main Street, and I know Cindy has sent the code enforcer down there a couple times, and when he goes down, the junk gets moved around, but as of today, he's got that corner again. It's pretty much I think he's a retail junkyard. But if he'd been given a ticket every day, he sure has not discouraged him one little bit. It's been that way for at least 2 years that I know of.
Yeah. Well, I
So
know we
anyway,
tried to work with
if you think
people.
those numbers are adequate under our current system, I have no
Somebody
objections.
is going to be enforcing this stuff if we follow it.
I think what we need to
Right.
do is start enforcing our own regulations.
So this is the current, so it says that this is the current ordinance.
Right. So these are the current, what have been in place.
Yeah, this is the current one, Chapter 17, Civil Infraction
Right.
Bureau.
Okay, so what was we're looking at talking about, maybe the first violation cost?
Yes.
Which I think moving that to 100 wouldn't be out of order if they have a 10-day window to
I agree.
certified letter.
Mm-hmm.
Yeah.
But
Increase that to 100? Is that what we're talking about? All right.
And the rest of them seem like they add up substantially. I mean, they're multiplying daily,
Mhm.
so. All right, so that would have to be drafted as a resolution
Yeah.
for the next meeting.
I don't even
Right.
know
No,
what
I-
enforcing.
Well, this one says they're set by ordinance, but in the past, we've tried to do any changes by resolution. So we'll either bring a resolution or ordinance, whatever we need to have done at the next meeting.
Well, I don't think you need it. You've got an ordinance dated 2/19/2001. What we need to do is start enforcing it.
Do we even have a code enforcement?
Yeah.
Oh, yeah.
Jim Schaefer.
He's been for at least 5 more.
All right,
Years.
I shut up. Getting
All right.
late. I need a drink.
So we want to change it to 100 then, the first offense, or leave it?
Crap.
I think we should start enforcing these things.
Yeah.
Yeah.
Start there first.
Yeah. Maybe that would be a good start.
I guess, does anybody want to make a motion to draft a new resolution for this, or do we want to leave it as is and just note that,
Start enforcing it.
to start enforcing it? I guess by hearing nothing, we'll just talk to Jim about trying to enforce these harder at this point
Mhm.
and leave it as is.
Okay.
We don't have to vote on that.
And revisit it at another time, correct?
Yes, okay. All right, so, where's my thing here? All right, so that brings us into announcements. I have one. So you guys will be seeing emails on this, but we've had our steering committee going on now for a while with the St. Clair Riverfront redevelopment plan. So we are going to have a kickoff meeting, informational meeting, open to the public on August 3rd at 6:30 at the Bell River Clubhouse. Yeah, over on King Road.
You will be getting flyers, these
Yes.
flyers in your email this week.
It's going to be posted. We're going to have some yard signs out in front. Trying to make it a pretty big deal. So there will be county level folks there and, a bunch of people. So would like you guys all to attend if possible. If you can't make it, like it says, it'll be on Channel 6. It will be recorded. But it will be posted all over the website and signage and a lot of informational packets. Outside of that, that's all the announcements I believe that I had. So if there's nothing else, I guess we'll move into member comments. Go down the line here. Trustee Blackstock.
Nothing, thank you.
Trustee Babel.
Nothing tonight.
Clerk Matei.
No, thank you.
Treasurer Hart.
Just wanted you guys to know that we are looking at, possibly updating some other fees because all of our banking charges have recently gone up also, and we just want to make sure we're covering all that. And I asked if there was like a standard, I guess, list of fees, like, for every department, and we don't have that, so we're gonna try to get that together too. Like the building costs, copy fees, anything that, we do. So it's all in one place, 'cause a lot of other municipalities have that.
There used to be a sheet with all that listed. It was up at the front, but
I know it's
they're
MIA.
gone. Yeah.
Thank you. Trustee Knotts.
I have nothing, thank you.
Trustee Richley.
Nothing, thank you.
All right, and I have nothing myself here, so I'll look for a motion to adjourn the meeting at 8:44 PM.
So moved.
We have a motion, we have a support to adjourn the meeting, 8:44. Any further discussion? Hearing none, all in favor signify by saying aye.
Aye.
All opposed, meeting adjourned.